So again, welcome everyone to today's webinar. The topic is selling your business starts today, the business succession planning. So whether you're thinking about selling in the near future or you simply want to ensure that your business is set up for long-term success, this session is designed to provide you with the knowledge and the strategies to navigate the transition process effectively. Now, many business owners believe finding a business is the biggest hurdle, but the real challenge that we want to tell you about is being fully prepared for that succession transition. Now, in this session, we'll cover key steps to make your business attractive to buyers. We'll talk about the importance of formal succession plan, the financial and tax strategies, as well as those common pitfalls to avoid. So whether you're planning, as I mentioned already, to sell soon or you're just getting started, you will find this session quite valuable. That will provide you with insights to streamline the process and to maximize your success. Today, our presenter is Alison Anderson. Alison is the founder and CEO of SuccessionMatching.com, a marketplace for buying and selling businesses. She's recognized internationally as a leading expert in business transition planning by industry associations, private businesses, and various levels of government. Alison has deep roots in rural Saskatchewan, where she grew up and began her career in banking and economic development. As a business owner herself, she understands the ever-changing and unpredictable nature of the business environment and how difficult it can be to find time for future planning. Currently, Alison is implementing her own succession plan, and she is here today to share valuable tips that can help you to save time and money. So we always have the best in-house at Tourism Saskatchewan, and so I'm going to be handing over the rest of the session to Alison. Alison, it's over to you.
Thank you so much for having me today to Tourism Saskatchewan. Then also thank you to the business owners as well for making time. Like the introduction said, I'm implementing my own succession plan, and the last few years have been extremely different for all of us to navigate. And one thing that I want to communicate to all of you today is it doesn't matter where you are in your transition plan. The most important thing is to get started and identify what your next step is today. So I'm hoping I can shed some light on that area for you. And so, like Tamika said, I do have roots in rural Saskatchewan. I'm originally from Weyburn. Spent a lot of my summers at White Bear and also at Crooked Lake. And so it's always been a special piece of my heart when I've been doing a lot of work in Northern Ontario with tourism. And so it's really cool to be working with Tourism Saskatchewan in our own backyard and a lot of the places that I got to visit growing up and still get to visit today. So I started my company in 2012, and the reason why this background's important for you when you're going through your succession plan is that we take a very economic development approach, and we've been studying this for quite some time. And in 2022, the Canadian Federation of Independent Business, which is Canada's largest business association, approached us and said, post-pandemic, we want to see what business owners and operators are facing. We want to partner with Succession Matching on industry reports. So our report was designed throughout 2022. We engaged their 97,000 members. And a lot of the data that I'm going to share with you today is based on that work that we did with them. And so the report title that we co-authored with them talks about the succession tsunami. And One of the most disappointing parts of this report for myself is when I got into the industry, over a decade ago, CFIB had launched a report that said in 2012 and then 2018 and then jointly with us in 2023 when our report came out, they surveyed the members. They asked who has a formal succession plan, and it's always been 9% of business owners have a formal succession plan. And in my professional opinion, that's grossly overstated because I've had phone calls from members where they thought that they had purchased a formal succession plan, but they might have bought an insurance product or they might have got some accounting advice. And there's two individuals in particular that they thought they had a formal succession plan. They had an insurance policy on the other person's life policy. And so they called us because they're mad that their business partner hadn't died yet. And so even defining what a formal succession plan is really important to get that message across. And 76% of business owners are looking at transitioning in the coming years. And we want to help you significantly increase your ability to do that. And whether that's to your current team, to family members, or to a third party, there'll be something for everything or for everyone in this webinar today. So there are 5 phases that you're going to go through in the business transition. And it doesn't matter if you're selling to a family member, a key staff member, or a third party. All businesses will go through this process. And so I'm going to do a little breakdown. And the next slide with some of the timelines is pretty scary when you think about it because, the timelines to transition your business, the average in Canada is 2 to 7 years. And so I'm going to walk through each phase and let you know how long that phase normally takes. And then hopefully you'll learn some tips and tricks today that you'll be able to speed up that process through some implementing some of this. So the first phase of the business, and again, it doesn't matter if you're not quite there yet. This might just be your very first step, but getting your books in order. So like Tamika said, I started in lending and then also in economic development where I was a loans officer at Community Futures. And there's a lot of businesses that don't have their books in order. So if you're sitting in that position, that's okay. That's really going to be your first step in getting your formal succession plan put together. And so again, part of that is also declaring all the income that your business has coming in, making sure that those taxes and stuff are up to date, because then eventually when a buyer is looking at your business, you'll be able to provide paperwork and stuff that isn't in fact what your contract sales are. So getting your books in order, depending on how much you need to kind of organize, this sale process normally takes 2 to 24 months. And the 24 months sounds like a very long time, but later on in the webinar, we'll talk about the the one-time personal exemption for lifetime capital gains. And you'll see why it will be 24 months is sometimes the minimum. Also getting your contracts and documents and then having an actual business valuation done. We get a lot of valuation questions. And so we thought it'd be super helpful to work with Tourism Saskatchewan and put like a standalone document that will be available in the Business Hub. And then also I'll walk through some of the different valuation methodologies today on our webinar. The contracts are as much as, your employee contracts, might be some of the like leases that you have, or it might be some of your vendor contracts. Kind of a rule of thumb, if something represents more than 40% of your revenue, your buyer is going to want to see that actually papered. We were working with a bakery transition and something like 70% of their sales came from the local grocery store, and it was a handshake deal. So that's kind of hard for a buyer to commit to trust that the grocery store would take over, continue operating with them as well. And so when you step back and you look at it from a common sense perspective, you need to have these steps down, because when you eventually go to engage a buyer, the first questions that are going to that they're going to ask you is how much are you looking to sell your business for? And you can't get to those points until your books are in order, all your contracts and documents are in order, and then have a valuation done. at that stage, having an honest conversation with your employees and with your key staff members about your transition plans. I'll never forget a Saskatchewan business owner we were working for. Um, I'll call him Ray. We went to visit him, and he's like, you know what, I like, really don't want to talk to my staff about this because then they're gonna know that I want to sell, and it's just like, Ray, you're 79 years old. Like, they'll actually be happy that you have a succession plan in place. And so um, I know this seems kind of unusual given that I run a marketplace that matches people to outside buyers. I firmly believe that your first conversation should be with your family members and your key staff. For a variety of different reasons. There might be some unspoken expectations that your family members have about what happens to the business, and we want to make sure that you can still have Thanksgiving with your families going forward, and then your key staff as well. So a lot of your transferable value in your business is having those people that have worked in it for so long continue with that business. And you might not realize it, but some of your key staff might visualize themselves as taking over one day. And if you skip this step of engaging family members or key staff, you might have some hurt feelings that will hurt you personally or professionally. So make sure you have some of those conversations. If you want some tips and tricks on how to position that, we worked with an HR firm that has a really good resource that we provide free. That's how to have those conversations before, during, and after the transition. And it's just kind of nice to have some of the step-by-step documents. And then once you've had those conversations, if no one's interested in and competent of taking over, then that's when we encourage people to look for a third-party sale. There's a lot of really fun statistics about who actually who actually is going to buy the business. One of the main misconceptions that there is as well is sellers think that their kids want to take over the business, but in reality, a lot of the kids don't. So 89% of business owners think that it's going to transfer within the family, and less than 22% of them actually make that transition to a family member. And then by the fourth generation, it's 1 in 10,000 businesses make it to the fourth generation. So there's quite a bit of gaps in expectation and reality in some of those instances, but throughout this entire process, one thing that you'll see is communication is definitely very key. So the third phase is due diligence. And so I know when I say this process can take 2 to 7 years, that is a very long time when you think about it. So the first place that you can save some time is if you put in the proper work in the getting your company documents together in phase 1, and then having those conversations in phase 2. If you put more work into those 2 phases, due diligence goes way more quickly. So on our timelines, we have that due diligence can take anywhere between 1 and 12 months. And so if every time a potential buyer comes to you and says, well, I want to see your contracts from your vendors, and those aren't all in one place, then it takes you a while to go find all those. Or if your buyer is eventually going to the bank, we'll talk about financing on the next slide. And the bank keeps asking them for documents, and then you're coming back and then you have to search those. So a lot of time savings can be had if you put a lot of time and effort into those first 2 phases. And so due diligence can go as quickly as within 30 days if you have a lot of those ducks in a row. And we always encourage sellers to think about this process from kind of a buyer's perspective. And so, similar to you, my business is my baby, or maybe some of you don't look at it that way, but if you were going to step in and buy your business from a buyer's perspective, what would they be really concerned about? And so a lot of times over the years, we see members that they might run their vehicle through the business, and rightfully so. There's a lot of business activities, especially in the tourism industry, where you have to run in and use that vehicle. But if you're not selling that vehicle with the business, what is that buyer actually buying? And so in this type of process, it's looking for any expenses that won't actually pass on to the buyer that the seller is having. So look at it from that perspective. And then structures and financing. This is always a interesting conversation between buyers and sellers. So, always ask your accountant for a proper accounting advice, but kind of a high level structure part of it is a lot of sellers that are incorporated want to sell the shares of their company because then they can take advantage of the one-time personal capital gains exemption that I'm going to talk about. And then on the flip side, most buyers actually want to buy the assets of a company. And it's because they can put that asset value and then depreciate it over time. And then they're not taking any of the liabilities. And so just so that you know, right away, there's usually a little bit of disconnect for buyers and sellers. And then a lot of transitions require financing. That's why we're going to spend an entire phase on it. But financing and understand how the buyer will access this capital. Going back to the second phase with family members and employees, a lot of people that we work with don't think that their employees might be able to access financing. If you think that that person's very competent, knows the business well, and be an excellent owner, please have that conversation with us because there are so many different great programs that they can tap into and lots of different structures and financing that your key staff might be able to look at in order to borrow money to purchase the business. So don't always write off just because they don't have 100% of the purchase price. I'm happy to share our knowledge on that as well. So jumping right into financing, again, going back to the Canadian Federation of Independent Business report, we're always looking at friction parts of the process. And the number one barrier on the buyer side is finding financing. And so a lot of sellers are like, well, why do you talk about financing in the seller material? And it's because it's so important to getting your transition over the line. It's great for you to understand the different avenues that individuals can go to for this type of financing, and also some of the timelines on it. When members sign up to our website on the buy side, we always say you need a business plan. Doesn't matter if you're buying a family business, or you're a key employee, or a third party sale, you need a business plan. And then oftentimes a lot of the transitions get slowed down because sure enough, the buyer goes to the bank and they say, well, where's your business plan? And so making sure that you understand the process that your buyer is going to go through is extremely important as well. 3 different types of financing that I'm going to touch on today are traditional lenders, government, and equity. So traditional lenders, when you're selling your business, someone like a chartered bank or a credit union won't lend 100% of the business value to your buyer. They're going to want to see some sort of equity in the game. And so where will that remaining equity come from? So your buyer might have a down payment. Happy to talk through what vendor financing looks like. So that means that you would leave some equity in the business. And then once the bank loan gets paid out, then you get paid out the additional amount. Or there's different loan programs, more so in the government lending side. Like BDC, I really like their asset loan where it lends 125% of the loan price. Say if you have some buildings that you can access. Again, I'm biased because I come from the Community Futures program, but if you're in rural Saskatchewan, I think they have the most competitive loan product for your industry specifically because of the flexibility in the loans. And so we used to write a lot of loans that, in a seasonal business, you have higher cash flows, say in the summer months. Some of you might have higher cash flows in the winter months, but it allows the borrower to make additional payments during those times, and then maybe just make interest-only payments in the off season, which really helps with cash flow throughout the year. So Community Futures can offer different programs like that. There's some amazing lenders in the province as well that we work with on the Métis and First Nations side. And so happy to walk through specifics once you guys start engaging your buyer on what type of programs might be available, and highly recommend that you reach out to Tourism Saskatchewan on that as well, because I know a lot of their stakeholders and their staff know a lot of those connections as well. So they're super helpful resource for you on that side of things. Private equity is kind of an interesting case because this has become so popular now for different individuals with some extra money to make investments in private companies instead of putting it directly into the stock market. And so we work with quite a few private equity firms or family offices that are looking for cash flowing businesses. So sometimes when there's inflation, you keep cash in the bank and it actually decreases in value because it's not keeping up to inflation. So a lot of say family offices will invest in a business because that they're hedging inflation. This and all three of these different types of financing don't have to work in a silo. There might be certain components that work with each other. So say your staff would be a really good person to take over the business, but they don't have the 20 or 30% to put down for equity. We could connect you with a private equity firm that would buy in as a minority stake in the business and work alongside your staff. Or similarly, you could layer on different types of loans from government lenders or traditional lenders as well. So structuring these financing is how your buyer is going to get the deal over the line. And so this is a very important component of the business transition process. So stage 5, I think in our society, we've almost romanticized this notion of startups too much. As many of you know who have started your own business, there's a lot of peaks and valleys, and it's hard. And so the transition period when your new owner comes in, and it doesn't matter if that's a family member, your key staff as the owner, or a third party purchasing the business, their phone's going to ring day one, which is nice for cash flow. A lot of them will have key staff in place. And then hopefully that corporate knowledge that you've built up over the last 10, 20 years, you're able to show this individual. I'll never forget when I was a lender, I had a flower shop that the individual came in just crying because right before Valentine's Day, they had ordered a really high stem count because they could sell a lot of flowers during Valentine's Day, but they didn't realize it was cash on delivery. And so owner transitioning a business like that, you would be able to walk your buyer through the highs and lows of different periods. And so just really want to congratulate you as a business owner that all that corporate knowledge that you've built up is the difference, in my opinion, of why people are so much more successful when they purchase a business than when they start a business, like staggeringly so. If you purchase a business within 5 years, it's still operating. If you start a business within 5 years, only 10% is operating. So a big difference to your buyer with all that knowledge that you get to transition. One key takeaway from the phase 5 is you don't have to structure it for everyday transition. We were working with a client that he had promised his wife that they were going to go on a 6-month trip right after he sold the business. And he had promised the buyer that he would mentor for a year after he purchased the business. And so that kind of blew up a little bit. And he called me, he's like, I think we need to find a new buyer. I said, let's go back to what we call your best alternative to a negotiated agreement. And we asked the buyer, what were you looking for in this transition period? And they're like, business is cyclical. I don't know where to call these suppliers and stuff. And so we're like, it sounds like if you could have phone access to him for that 1 year period, it would help. And so they ended up closing the deal, and we were very happy. And so was the business owner's wife and family, that they finally got to travel and enjoy the fruits of growing a business like that. So that transition phase is really pivotal to your buyer coming in, and will drive up a lot of the value in your business, and will also make sure that the legacy of your business will continue on, because it will really set them up for success. So business valuation methodologies. this is always an interesting topic, and I don't expect that you're going to be a huge expert at this just from watching this webinar. But I think it is a very important place for us just to look at the different types of valuation methods. And so, and I'll kind of explain the type of business that would use this valuation method and or why some people use a specific valuation method. So the first one, I kind of, well, full disclosure, I think I might have listed this out in the order that I prefer. These are the types of valuation methods that are my favorite. I really like a discounted cash flow analysis. And so this is the projected future cash flow of the business and how if you have a discount rate, what the present value is. And I know that sounds very complicated, but essentially what it means is based on your historical financials, how well will this business do without you? And so it's a very easy calculation. It just takes a long time. And so unfortunately, that's why a lot of people don't do the discounted cash flow analysis. You end up with like 11 spreadsheets. But it's fairly utilized in banks and financing and stuff. And so that's usually my favorite. The book value on asset base. I'm a firm believer of we're so lucky as Canadians to have the personal exemption and on capital gains. And so, you know, an asset sale is required sometimes, but, you know, we would prefer if people didn't have to sell off the assets of the business. When my father passed away unexpectedly, my mom had to sell off like the assets in the business, and it just like it was a little bit more of a mess, and she didn't get as high of a price that she could have. And so like ongoing concerns, for example, like if you have to close operation and sell off the different assets minus liabilities. And so essentially paying off your debt with the leftover proceeds. So a good example of this is say you're selling your car. Normally you have to pay off your car loan first. And so that's the book value. That's assets based. And then earnings multiplier. A lot of people have heard of EBITDA, but don't quite understand what it means. And so it's just a calculation of taking out what your earnings are minus a few other line items in it. I don't love this one as much because it's thrown around and not very well understood. And it's for usually quite larger businesses. If you're a smaller business and you have, say, a CEBA loan sitting on the books, this doesn't really take that into account. And so it's sometimes applied to smaller businesses, and that's not really the best interest of anyone. And then times revenue is kind of in the same count. The reason why EBITDA, earnings multiplier, and times revenue are utilized so frequently is because it literally takes 5 seconds to sit down and do the calculation. And so people are just kind of ballparking it. And times revenue is usually if you're a franchise and you're selling X amount of burgers and X amount of fries, that's usually okay to use the times revenue model. But not a lot of people are selling franchises in that sense, but still applying this type of valuation methodology. Market comparables. The great thing about tourism businesses is that there's no one like you. The bad thing about that in a market comparable is there's no one like you. And so it's really hard to find someone that has something as special as your operation that people are going to travel to in your province, and that's why you're a destination. And so market comparables are a little bit difficult in that sense. We've also seen so many different swings in the last few years that timelines really do change market comparisons, and so that's a little bit more difficult. And then market capitalization, that's for more publicly traded companies, and so it's very unlikely that any of you will use that calculation as well. But that's just kind of the the six primary ones that get thrown around a lot. Um, do you need a formal valuation? It really depends on your timelines and um and also like the expenses. Like there's one of the big four accounting firms, their formal valuation is $150,000. And so like a lot of businesses just can't cash flow that. And then I'm a firm believer that people should have their formal succession plans years before they actually look at selling. And if you go through the expense of hiring a chartered business valuator, normally their plans are good for 2, maybe 5 years. And so I'm trying to make sure that you avoid some of the expenses that you don't need to up front. And so formal evaluation, maybe just contact well, we have a blog with Tourism Saskatchewan that gets into that a little bit. But this is more of a conversation piece to have, maybe in the questions section. And then the capital gains exemption, again, we're very, very lucky as Canadians. It's fairly structured. And so in our first part, when we were talking about the phase one, having it in place for 24 months. So it has to be structured to take advantage of the lifetime capital gains exemption, which is exactly what it sounds like. One time in our life, we're able to use our personal exemption on the sale of qualifying businesses. And so, in simple terms, if your tourism business qualifies, then you can sell the shares of your company and not pay tax on them. And so it's quite a significant amount, and it's also it's for every shareholder. So we deal with a lot of husband and wife couples that own 50% of the business, or maybe have a different partner in the business. Each individual, as long as they haven't used that personal exemption before, you can take advantage of that. Some of the make sure that it's qualified. Your accountant will be able to tell you if your business qualifies. It has to be incorporated because it has to be a share sale. And the other key thing to keep in mind is it has to be structured properly and on the books for a minimum of 24 months before you go to sell the business. And so that's why that first stage, if you plan ahead, you're able to properly take advantage of some of those tax saving portions. And then you can also structure the deal a lot so that you can minimize some other tax planning as well. So happy to send over some resources on that, but definitely talk to your accountant about that because you could save literally hundreds of thousands of dollars in tax just based on that alone. We're going to jump into a fun case study because everyone loves case studies, right? And so our first one is selling to a third party, and then staff buyout backing. And so, a lot of business owners are looking at transitioning. Less than 9% have a formal succession plan in place. And so we wanted to highlight this and talk about a case study where an owner could use 3 different parts of that financing. So this individual has been an owner in Saskatchewan for 25 years. The business is valued at 1.5 million, has 10 employees, and is known for guided fishing and hiking tours with some campground attached. And so one of the biggest issues is like the employees for her business can't afford to buy the company outright. So, but they do have some strong management backgrounds. The owner, she's been doing a lot of the accounting, but wanted to look for a private investor. And so the staff was able to leverage. She wanted to take a portion of her capital gains at 1.25 million, which is what the current rate is right now. But it keeps up with inflation. So this is going to be an evergreen webinar. And so look at what the current rate of the lifetime exemption is, and then use a 5-year loan payback for the remaining amount, being able to purchase some of it. And sorry, I'm trying to speed up because I realize we have a little bit of a time as well to catch up. So the first portion of the shares only equals up to 80%, and then needed to find a private buyer to put down some of the capital, or else the owner could have did some seller financing. One of the key takeaways in structuring deals like this is banks will want to make sure that they get their money out first. And so a private investor, or if you're doing seller financing, they'll want you to get your portion of the equity out once the bank loan is paid out. And so this owner had to wait for the 7-year period of the loan before they were able to get paid out on the remaining portion of it. So again, timelines play in a great deal there. So if you're doing a seller financing and they're financing it over, say, a 7-year period, you do have to wait a lot longer to get the proceeds of the sale. But sometimes that's what's required to get it over the line and help the key employees purchase some of the business. The structure that they were able to utilize was the investor coming in only took 10% and then sold that back to the company and went down to 5% once the loan was paid out from the investor to help with the equity. I'm just going to open it up for questions from anyone in the audience. Please put them in the chat box, and we'll go through them one by one and see if we can unpack some of the different aspects of the webinar that you might have that's related to your business. And don't worry, it's anonymized. We won't call you out as an individual participant.
I do have a couple of questions for you. We do have, I would say, 6 minutes. And Alison, I do have a question. Now, when you talk about selling your business, I know that it's not just confined to Canadian buyers selling to Canadian operators selling to Canadian buyers. But what if they want to go south and they want to sell to the American buyers? Can you just divulge some information in terms of what are some of the key things that they need to keep in mind when we're talking about selling to the American buyer?
Yeah, absolutely. Thank you for your question. We've been actually getting quite a bit of this a lot, where individuals are looking up and they might be looking at either two pathways, diversifying their holdings. So they want to buy a business in Canada. So if something happens to some of the other holdings in the US, that they have property somewhere else. Or some of them are actually looking to immigrate to Canada. So I briefly mentioned the Saskatchewan Immigrant Nominee Program. Some major things to keep in mind when you're selling if you're selling your business to an American coming in through that program, is this program does take a little bit longer to go through. And so the last individual we had go through Saskatchewan, I think they had their permanent residency within 3 years of going through the program. But from a seller's perspective, we always think it's important to be mindful of, what's most important. Is it a fast sale, the highest valuation, getting it over the line? And so just want to warn people that if Americans coming in to go through the immigration process, that rightfully so, the Saskatchewan government spends a lot of time due diligence and some of the processes on that side for bringing investment in. Some people are looking for the first stream where they're just looking at putting investment capital in. We're very lucky as Canadians that Americans are very used to making cross-border investments. So like my company, for example, we're based in Saskatchewan, but we have some American venture capital firms on the cap table. And so some people are a little bit reluctant because they think it might be treated a little bit different, but out of all the jurisdictions, taking on American capital, so say your staff purchases businesses with a private financer from the US, they're quite used to it, and it's pretty easy. The one downside to selling it to an American that's doing it cross-border is unfortunately a lot of the loan programs don't relate to them. But from a bank's perspective, you can understand why, because if they have to go collect on that business, it's harder to collect from someone that's not in the country. And so those are kind of the top things to keep in mind. there's a lot of American money looking at Canadian assets right now. You know, it's and I'm sure we're seeing this a lot in the tourism sector as well. A lot of American tourists are more inclined to come to Canada when their dollar is a little bit stronger. So same thing goes on with business acquisitions. They look for really good cash flowing businesses when their dollar is so strong in Canada, so that they can so their dollar goes a little bit further.
All right. Thanks so much, Alison. I do have another one for you. I mean, some persons may be on the fence whether they want to sell or not sell. But what are some of the, you know, opportunities that you see are out there to for either buying or selling in the future years?
Yeah, like I think that's well, if they're kind of on the fence, I know I mentioned this kind of in passing, but I firmly believe every business should have a succession plan. This was really hit home to me during the pandemic because if you have your succession plan is essentially a strategy document that it doesn't go on a shelf. It should be updated regularly and it helps you understand some of the different moves that you should be making. When I set up my own succession plan, I thought one position that I wanted to hire for was the best move, but like the return on a different position was much higher. So it's like even though I'm so much fun at dinner parties because this is all I ever want to talk about, especially with you and Karina. You guys are always so lovely with our conversations on it. But I changed my next hire based on my succession plan. And so if you're on the fence of, you know, if you should be selling soon, kind of high level, remember there's more buyers than sellers right now. At least have a succession plan in place because you don't know what's gonna come up. And then yeah, I just think that there's so much opportunity in business. Like I know there's a lot of stuff going on in the world that creates anxiety, but you're in an industry where a lot of people they might not go on an international trip, they might come up to Canada, and so I think there's a lot of opportunity to expand on that. And so I know we're at time, and I want to be mindful of everyone's time. So thank you so much for having me today. Happy to answer any follow up questions. So please reach out to Tourism Saskatchewan if you have some follow up questions.